Okay, everyone sees the recording? Everyone sees the video? Okay, great. And so today we're going to be talking about long-term assets. So until now, we've talked about the accounting flow. We've talked about debits and credits. We've talked about the trial balance, how to, what's a normal balance, the accounting equation. That's the fundamentals. We also talked about current assets, right? Cash, how to do bank reconciliations. And we've talked about accounts receivable. So now that we've talked about all the current assets, we're going to keep going down the balance sheet and we're going to start talking about long-term assets. So long-term assets and short-term assets, what are the difference? We've talked about this before, but what's the difference between a long-term and a short-term asset? Feel free to put it in the chat.
Less than a year, short term, more than a year, long term.
Correct. That's good, Mujaba. Thank you. So generally speaking, is if it's less than a year, it's a short-term asset, which is our accounts receivable, our cash, etc., our inventory, which we've also talked about. If it's greater than a year, then it is a long-term asset. That's a rule of thumb. What the actual rule is, if it's less than the business cycle, but most business cycles are less than a year or a year. So if it's a year or the business cycle, if the business cycle is greater than a year, like if you have a winery, your short-term assets are actually based on the winery's life. So the average time it takes to develop something and sell it. So farms might have different long-term versus short-term assets, but most companies have a cycle less than a year. So we assume short-term is a year. So that's just a complexity or kind of a curveball that can be thrown at you. So we've gone over that. Cash, inventory, accounts receivable, and prepaids. Those are our general short-term assets because we expect to use them within a year, and we expect their liquidity to be easily convertible to cash within a year. But so these long-term assets, we expect to use or have a liquidity ratio that's longer than a year, right? We expect them to be able to have some kind of benefit for a very long term. And so what does that mean? It means that we're going to include things like plant assets, land, long-term investments, all of these different long-term big categories are going to be under long-term assets. These are generally much more valuable or like higher dollar value for a business. And so there's a lot of complexities related to them, right? If you run a firm and you own an office might be one of your biggest assets, right? And so there's going to be a lot of considerations around that asset. So what is a plant asset? A plant asset is tangible. We're actively using it in operations. We have an expected benefit for future periods, and we generally call it plant, property, and equipment. So what does that mean? That means it might be machinery that we have, valuable machinery, not a small, let's say $100 printer. We're not talking about that. We're talking about a $20,000 printing press. It might be a building. It might be the land for that building. And so when we're getting an asset, when we buy an asset, we have an acquisition cost, and then we have a cost associated with the use, and then we generally dispose of the asset, either through selling it or getting rid of it. So this is an example of a car, right? So we've all heard this before, but if you're buying a car, your car loses value when it's right off the lot, right? Everyone kind of says like, oh, if you buy a new car, as soon as you drive it off the lot, you lose value. That's not necessarily true, but it's true from like a fair market value perspective. That's not what we're talking about here. We're just talking about in concept, when we purchase an asset, we have an expected value at purchase and we have an expected value upon disposal. And then because we're using accounting, because we have the matching principle where we have to match expenses with the revenues they generate, we have to capitalize that acquisition cost and then recognize it over the period where it generates revenue in the form of depreciation expense. And so when we're talking about depreciation, most people use it in common language for their car, like, oh, my car is depreciated as soon as it got off the lot. That's not necessarily the accounting definition. It's similar, but the accounting definitions really we're trying to match the expenses to the revenue. And so if your car dropped in value $10,000 after you drove it off the lot, that wouldn't be our depreciation expense. We're going to adopt methodologies similar to what we did for inventory in order to match the expense with the revenue that's being generated through that car. And so all of these pieces have complexities. What happens when we acquire an asset? How do we determine the acquisition value? If I buy a car, do I include the taxes? If I buy it with a warranty, is the warranty included in the car cost? Or is that a separate expense? When I'm using it, how do I depreciate that asset? And then when I dispose of it, what if I sell it for a gain? What if I sell it for a loss? How do I recognize the gain and loss? And then how do I adjust the depreciation expense accordingly? So that's what we're going to be learning today. So that first piece, the cost of determination, is the purchase price plus all expenditures needed to prepare the asset for its intended use are the acquisition cost. This is very similar to inventory, right? That's why I'm telling you, if you've been doing your homework and quizzes, you'll start seeing the similarities in accounting and your life will be a little easier. So anything that we need to get the asset up and running. So let's say I am installing a piece of machinery, and let's say I'm making soy milk or almond milk, I think is the craze now. And I have a piece of machinery that I need to make my almond milk. And then in order for that machinery to work, I have to have a team come out and install the machine. And then afterwards, I have to have a team that inspects the machine to make sure that it's up to regulatory standards. And then I have some general other costs to like polish the machine and make sure that it looks good on the floor. While the concept of the acquisition cost would include the dollar values used to install the machine. So the installation would be included in that because I can't use it. And also whatever to bring it up to the regulatory standards. But then if I did anything on top of that, that wasn't needed to prepare its asset for its intended use, like if I put a decal on it or something, that's not going to be part of the acquisition cost because it's not needed and it'll be immediately expensed. So the cost determination, if I'm giving you a multiple choice question, you will have to go and determine which of these are acquisition costs and will be capitalizable. By capitalizable, we mean that it will be an asset on the books, not an immediate expense, right? We mean that it'll be an asset that's amortized over a period of time. And then you'll have to be determined what's an immediate expense because it's not directly relatable to the asset being used. So acquisition costs include all normal and reasonable expenditures necessary for the plant asset to be ready for use. Let's see. So for machinery and equipment, these are some examples. The purchase price, installing, assembling, and testing the machinery, taxes, the transportation charges, similar to inventory, right? We did the FOB. Like if we have transportation charges we pay for it, it's in our machinery and equipment, and the insurance. Some things that wouldn't be there are the repairs and maintenance afterwards, right? Or if we are designing or cleaning up the machine, making it look nice. For buildings, this might be the cost to purchase construction, the brokerage fees, right? Our real estate fees, the title fees, the attorney fees to close the building, the taxes related to the building. What isn't it? What if after we're done with the building, what if we paint it? Is that an acquisition cost? No, maybe that's just us painting the building. If it's not really valuable, we don't really need to capitalize it. It's just part of maintenance. Or what if we buy office furniture? Or what if we buy plants for the building? Maybe not necessarily necessary to use the building. But that's determinable, right? That we can make that judgment call, and that's where accounting gets interesting. And then land improvements, parking lots, driveways, fences, walks, shrubs, and lighting systems. So if we're buying a building on land, if we're upgrading the land, then that can also be capitalizable because there's a value associated with it. Note that land itself is not depreciated. And this goes to show you the value that land's held for so many years. And if you buy land, it's the only accounting asset that isn't depreciable because they assume that it's not going to lose value over time. It's going to gain value. But because we don't do fair market value accounting, we won't increase the value over time. We're just always going to assume it's what we paid for it on the day of purchase. So we'll have to separate, if we buy land in a building, we'll have to separate out the value of the building and the land because the building is depreciable and the land isn't depreciable. And so the land costs that can be included are property taxes, surveying fees, title search and transfer fees, real estate commissions, purchase price, anything that you need. You can't get away with not paying these. You have to pay them to get the land. But if we mowed the grass on the land after, that's not an acquisition cost, right? That's a maintenance cost that would be expensed immediately.
So I have a question. When you buy a building, it comes with the land. How do you separate the land and not depreciate it and the building and depreciate it?
Good job. Excellent question. And that's what this question is. This is the example. Perfect. Yeah, what I was about to cover. And so you're following this very well. So many times when we buy, like if you bought a house, you spend a lump sum for the house and the land that the house is on, correct? And so we have to then determine what of that value is associated to the land and what of that value is associated to the building, because one is depreciable, one isn't. And so the way we do that is called a fair market value allocation. And so we're going to start going to these allocation methodologies that are extremely valuable. This is really where accounting, you start getting the nuts and bolts of accounting, is a lot of times we're looking at dollar values. Transactions are oversimplified on paper, and then it's our job to find out the details due to the oversimplification. And so we do that by taking a full dollar value and then allocating it based on fair market value. So what's a fair market value for building and land? It's appraised value. So we'll get an appraiser to tell us, well, the building's worth $60,000, the land's worth $40,000. We know that they paid $90,000, right? So we'll do some math and we'll find out that, well, $60,000 of the $100,000 appraised total is 60%, the land is 40%, and then we multiply those by the $90,000. Does that make sense? So that 40% times the 90,000 gives us a $36,000 allocation. This is a very common methodology for us to use in our in accounting, where we take estimated fair market value and then we allocate the actual payment based on the fair market value allocation. The fair market value allocation here is the appraised value. Is this making sense? So that 60,000 divided by the 100,000 of the appraised fair market value is the 60%. That's 60 divided by 100. And then we take that 60% times the $90,000 of cash we paid in order to allocate the $54,000 of cash to the building. Then that $54,000 would be depreciable, and the land of $36,000 would not be depreciable. Did I go too fast there? Did that make sense? Thumbs up, thumbs down, thumbs sideways. Okay, good. I mean, slow me down. I've been doing this for a lot of years, so I don't want to go too fast. Let's just do the accounting on the sheet. Where's the sheet? Accounting 101 notes. I'll put it up here. We'll add this here, sheet 10. This will be our depreciation practice. So you can see how the math works out. Okay, I'll put it here. Okay. And so here, our lump sum purchase. We'll call it depreciation. Accounting. And then we'll say lump sum purchase. So we know we're paying $90,000 payment, 90,000. The appraised value of the land and equipment, the land and building, is $100,000. We know that includes a building and land. The appraised value is $60,000 for the building and $40,000 for the land. The percent total, so we can sum this here. That is divided by our appraised total, 60% of the appraised total, and the land is 40% of the appraised total. Does that make sense so far? How we did the math. Good. And then we say cash paid. Cash payment allocated. We only know we bought the building and the land for $100,000. That's all we know. That's what's on the contract. But we have to allocate that that $90,000 based on the appraised value. And so we'll take that 60% and multiply it by the payment. We'll take the 40% and multiply it by the payment in order for this amount equals our total payment, right? Because we just paid $90,000. We paid, that's all we know. We know we paid $90,000 and we know the building's valued at 60,000, the land's valued at 40,000. So we allocate that cash payment based off the percentage of the fair market value or the appraised value. Does that make a little more sense? Cool. And you can use this sheet for the calculation. Cool. And then from that, the building would then be depreciable, the land wouldn't be. And so here's an example that we can go through. Compute the amount of cost of the new machine given the following. And so this is something that we will see on your homework or quizzes. The gross purchase price is $700,000. We have some sales tax associated with it. We took a discount. We have an FOB shipping point, which means that we're going to be paying for the freight costs, right? This is again where we're seeing like the FOB. This is building off of prior knowledge. If you didn't get that, you have to go study it again. The 3,500. There's assembly costs. There's necessary machine platform. The keyword there is necessary of 2,500, and the cost of plant used in maintenance machine. So that's 4,200. So I'll ask you to calculate what's the cost, the acquisition cost of the new machine. What do we include? Well, we definitely include the gross purchase price, because all we're asking is what is required. What can't we avoid paying in order to use this machine? Well, we have to pay the purchase price. We have to pay the sales tax. Government's not going to let us get away with that, so that's included. The purchase discount taken, we would reduce our price by that, right? We got a discount. We can't include that in the acquisition price. The freight cost, because it's FOB shipping point. If it's FOB destination, we don't include it, right? It's our freight cost that we're incurring. The normal assembly cost, right? Because it's an assembly, right? We need the machine to be assembled before we can use it. And the machine platform, because it's necessary. The maintenance of the machine, that isn't an acquisition cost. That's after acquisition, so we don't include it. The sum of all of these is our $737,000. So that's the kind of questions I could ask you. I could, same thing with a lump sum purchase, right? I can combine both of these to say, determine the cost and then determine how it should be allocated if it's a lump sum purchase. Any questions there?